Well, I haven't worn a tie in a while, but today was Daddy and Donuts date, and I promised my 4-year-old I wouldn't take it off. So while my waistline is inflating from donuts, we're going to talk about headline inflation, which is coming down this week. So in what will be one of our more serious weekly commentaries, talking about the economy and data, you're gonna have to do that and listen to me with this beautiful pink and blue tie on again that was made by my 4-year-old Isla today at Daddy and Donuts. Wanted to talk about, is the shift upon us, is really the title of this week's commentary. Again, whether we're talking about tops, to markets or inflation or bottoms, it's a process. There isn't a singular moment that you point to where the epiphany hits and you're sure. But the anecdotal signs, again, may be building up. So I want to walk through some of those from things, just the punditry. What are the talking heads of the big banks and institutions saying to actual data itself? What is that looking like? And again, how do we pull this together into something actionable? So after what has been a historically bad run of sentiment, whether you want to look at small business sentiment, investor sentiment, which is going into its 40th plus week of bears outweighing bulls, a record. You've had a lot of pundits, the big talking heads of the large banks and institutions for some time now, issuing dire warnings about what may lie ahead. An interesting thing is starting to happen, though. Probably one of the biggest names in the industry, of course, is Jamie Dimon, the CEO of JP Morgan, who made big headlines last summer calling for an economic hurricane. He's now walking those statements back, saying, the phraseology was probably a mistake. At the same time, he says, hey, the storm clouds are probably already upon us. This is maybe what we were expecting. And yet, as often the case, saying, but it could get bad again. So making sure he has his placeholder in there. Goldman Sachs probably breaking from the pack for some time now, saying, we don't really think there's going to be a recession here. We don't think there's going to be a recession in Europe, which was the headline making news this week. But at the same time, talking about volatility and anything can happen and hedging their bets as well. Lastly, Yardeni and Gabelli, two big names, stock pickers, are expressing a lot of optimism. Yardeni said the outlook for the world economy is improving, while Gabelli noted that earnings going into 24 are going to, quote, be terrific with an outlook that's pretty bright. So what do you make of that? Well, again, I think the big thing is nobody knows, which is why everybody hedges their bets, myself I'm sure included. But when you start to see this shift in sentiment, it can be, again, a precursor to a new beginning, and especially when at least a lot of these guys are moving around big money and again, setting course for some institutions that can throw their weight around. The second big point is the data also seems to be either in a bottoming in terms of earnings or topping in terms of inflation process. So again, digging into that, some interesting things happen. One is, and I wanted to call this out again, ISM data, a nerdy data point. I've had people bring it up that have come out to me and said, what is this thing that you talk about? It really just looks at the state of the manufacturing economy and the service economy, two broad-based parts together. They both fell into contraction territory this week. Some headlines, if you're reading the kind of nerdy stuff that I do, made a big deal about this. Here's the issue, and we talked about this a little bit last week. It's usually a lagging indicator. So if we're looking at this data, yes, it's both fallen into contraction. Some English majors tried to make this sound exceptionally bleak. Usually, historically, when you finally get to the point where the reading's out and both of those things are negative, it lets you know you're already in the middle of the hurricane and probably on your way out. So again, there's no one tell, there's no one data point, but far from being a harbinger of danger to come, it probably indicates, again, we're closer to the end of this story than we are at the beginning. Second thing I allude to is earnings itself. S&P Global used natural language AI to process through all the different earnings reports as they're rolling in, and they're finding some interesting things. Outside of what can be kind of the negative, flowery language that people are putting around their general outlooks and data is a pretty positive backdrop. And so what the AI is saying is if you look at these earnings report, on the whole, it's actually positive. While some of the sentiment is as low as it's been in some time, on the whole, those earnings reports, about 82% of them are indicating positive. And historically, there's been a strong correlation between those outlooks and where, in fact, earnings do head. Lastly, most importantly, again, to relate back to the inflating donut waistline that I'm having this morning, is inflation itself. So the big report that everybody was waiting for was the CPI report. Of course, people are taking two sides to what it actually all means. Some are focusing on the annual number, dropping to 6.5 and saying that's still very high. Here's the problem with that, and really a short-sighted way of looking at it. It really is about the recent trend. And if you look at that, on average, CPI has averaged 0.15 over the last 6 months. You annualize that out, and we're looking at about a 2+% rate of inflation. And that's really what's important because here again, those interest rates, the Fed's hikes take time to work their way into the system, and we're seeing they're happening. And so again, you don't wait until you've got that 2% headline number and keep hiking until you do. You'd crater the economy, which brings us to the next point, which is, can the Fed avoid the hard landing? I think there's some good reason to believe that they can. One is, as we pointed out last week, the resiliency of the labor market. The second is the Fed seems to be waking up. You had Fed Governor Harker saying, I think 25 basis point hikes are really what's called for moving forward. And Governor Barkin coming out and saying, quote, we need to steer more deliberately, which is some pretty not so subtle code for, hey, we need to be careful what we're doing here because again, so much of what they've already done is still working its way through the system. You need to try to project as opposed to just look at where you're at today. Pulling it all together, what does this mean? You've got to look through the storm as an investor. So again, we know where inflation's at today on an annualized basis, 6.5. It's much more moderate on a month-to-month basis. It is moderating, should project out to again even lower levels moving forward. Yes, we just are in the midst of a bear market, and yet if you look at historically what comes next, 2/3 of the time you've had a negative year, it's been followed up by a positive year. Since the Great Depression, only 8 times in history have you followed up a negative year with another negative year. And here's again some numbers to keep in mind. After a calendar year decline of 20%, your average return, again an average, not a guarantee, 1-year number is 22%. Your 3-year cumulative return is 41%. Your 5-year cumulative average return is 72%. So yes, things can feel bad right now, but the question is, where are they going to be tomorrow? Markets move in counterintuitive ways, and they often will change far before the data does. So stay patient, stay disciplined, find that great partner, and know that eventually these clouds will pass. Thanks so much.